Hello, I'm Donna Sawyer from the Finance News Network, and joining me is NAB Chief Economist Markets, Rob Henderson. Rob, welcome back to FNN.
Thanks for having me.
Let's start by talking about the year that was. The ASX is hovering around the 5,000 mark. How would you describe the year that was on our markets?
Well, look, I'd really describe it as a year of two parts, because the first half of the year, global stock markets were pretty buoyant, really, and I think that reflected the Federal Reserve pumping $85 billion a month into their economy, and that reflected in our market as well, with strong gains following the US market. But from May, when the Federal Reserve started to talk about tapering its bond purchase, in other words, slowing down the rate of easing, we saw a turnaround in markets, and particularly that meant that the US dollar was stronger, US bond yields rose, and that really dampened the buoyant attitude previously evident in the stock market.
So where do you see the stock market by mid-2014?
Well, look, I think the stock markets globally have anticipated the pickup in global growth that we've seen over the last 6 months or so, and of course in the US they've now got a pretty good self-sustaining recovery going. And of course the Asian region is also doing pretty well, with Europe more subdued. So I think we're probably going to see more gains, but not as strong in the coming 6 months or so. And that's because I think markets will have to wait for the economies to catch up to the preemptive nature of stock markets in 2013.
The federal government has today released its mid-year budget review. Do you think the forecasts were realistic?
Well, look, I'd have to say, Donna, that this time around I think their forecasts are more realistic than they have been for a year or so. In particular, they've reduced their outlook for nominal GDP, particularly in the out years. So that's 2015, 2016, 17, where previously they had really strong growth. Now they've tailed that back somewhat. Now that does result in a higher unemployment rate though, and it also, I think, is the main reason why they see bigger budget deficits out there in the out years than we had before. But overall, I'd say these numbers are pretty much in line with the way NAB sees the world in the next 12 months or so.
We've seen interest rates at record low levels this year. What's your outlook for interest rates in the new year?
Well, look, I have to say that I think the Reserve Bank is coming towards the end of its easing cycle, and that's partly because our housing market's going gangbusters at the moment, so they don't want to pour any more petrol on that fire. But having said that, I also think that the next 6 to 12 months is going to be pretty soft for domestic-facing firms in our economy. And I think there's still room for 1 and possibly 2 rate cuts out there, but we're really looking towards the middle of next year before that sort of story will come to fruition.
What specifically is your rate call for January?
Well, our rate call for January and for the February meeting is that they leave rates on hold. We don't see them coming back right now. We think they're pretty comfortable. But as I said, as the year progresses, the first half of the year progresses next year, we think we'll see a rise in the unemployment rate, ongoing low inflation indicators. That will give them room to move in the middle of the year. So nominally we've got that in May, and perhaps one more after that if the economy's still soft.
Rob, what has your read been on corporate activity so far this year? Are you anticipating there'll be a pickup next year?
Well, look, the truth of the matter is that mining was very, very strong even in the first half of this year, but business conditions in mining have deteriorated dramatically over the past year or so. And if you look outside of mining, basically sectors such as retailing, manufacturing, housing construction, they've all been pretty weak for the last few years, and that hasn't improved. The parts of the economy that are holding up employment growth are the services sector. So particularly health, education as well, I'd mention, and business services. They've been all doing just so-so, but growth in them has been strong enough to stop unemployment rising very steeply. Although, of course, it has moved up from around 5% to around 5.75% at present.
Do you think the drop-off in mining investment is a long-term reality, or can you see it picking up again?
Well, I think that the growth in mining investment has been a massive driver of activity in our economy. It went from about 4% of GDP up to about 8% of GDP, but clearly it's peaked. And of course, when a company puts a new mine or a new LNG plant in, they expect that to last for a good decade or so. So that means there's a lot of spare capacity being put in and being completed right now. I don't think there's going to be any call for an increase in mining or energy investment for the rest of this decade. So it won't be until 2019-20 that we might start to come towards the end of the useful life of some of the recent investments. So it's going to be a period when we have to find other drivers of growth outside of mining investment.
Let's talk about the US. Some say the Federal Reserve could pull back on its bond buying program as early as this week. What are you expecting based on the mixed economic data that's been released of late?
Well, look, I don't think there's any doubt there's a private sector self-sustaining recovery underway in America now. The last 2 months of their private employment data has showed us that they're now putting more than 200,000 jobs per month onto payrolls. Now that's very, very strong. And at the same time, the manufacturing sector is strong in their data. Core retailing has been pretty strong. So I think the US economy does look pretty good. And at this point, it's probably about time that the Federal Reserve stop pumping it up with its extra $85 billion of stimulus every month as they're doing now. So if it's not at the December meeting of the Fed, I think the January meeting, and as late as March perhaps, but it looks to me like they're getting ready now to start winding that program back, and I think that would be appropriate.
Finally, Rob, the Australian dollar is currently hovering below 90 US cents. What's your outlook for the dollar in 2014?
Well, look, we think it's a bit more the same. It's pretty clear that the reason why the currency fell in the last 6 months was because the market was coming to the conclusion that the Fed would begin to taper, and that tapering meant higher bond yields, higher US dollar, and on the other hand, a weaker Australian dollar. Now, we think a lot of that, the coming decision to taper is already priced in, but it's true that once you start winding back on the bond purchases, say 85 billion goes to 75, then eventually it goes to zero, eventually they start tightening. What that means is higher bond yields in America, a higher US dollar, that must mean a lower Australian dollar. On top of that, we think there's still some downside on Australian commodity prices because of the increase in supply after all the mining investment we've seen. So those two things together mean to us that by the middle of next year, we're thinking that the currency could be around the 85 cent mark. And certainly by the end of the year, we're looking at lower levels than that. So potentially sort of around 82, 83 cents by the end of 2014.
Rob Henderson of NAB, thanks for your time.
It's been my pleasure.